Hello and welcome back to another episode of Wealth, Purpose, Peace. I'm Jonathan Hall,
Brian Grant.
and we are financial advisors with Warburton Capital. So today I think we have a really interesting topic, Brian. And as of the time of the shooting of this podcast, it's actually pretty relevant to what's going on. So I thought it'd be interesting for us to talk about market volatility, what it is, what it means, and then questions that people might have around it. And as we like to do on this podcast, we're going to get to the question behind the question and maybe talk a little bit more about the emotional side of market volatility rather than just the math, numbers, investment side.
Sure.
So let's start with this. How would you define market volatility, Brian?
Yeah, it's what's happening, right?
Yeah.
Just look at the market any given day. Yeah, I mean, so in the simplest terms, I think it's just rapid and really unpredictable price movements in markets. And I think unpredictable is kind of an important word there. Maybe we'll get back around to that at a certain point. But it's this rapid price swinging in markets that feels impossible to control. And I think, to your point, right, there's the math, there's how do we measure volatility, there's the VIX index, there's all these things, but ultimately the emotional kind of tie-in people feel when they think about volatility, and then the reaction, their response to it is what really can lead to either positive or extremely detrimental outcomes. So I think it's important to focus on the emotional part. I don't think that's some secondary fluff, right? That's where people, I think, can really fall into some traps.
I absolutely agree. I mean, how many times have we seen that working with clients where you enter into a time of market volatility and then it can be nerve-wracking. It can be concerning to suddenly watch your portfolio go from, $3 million to 2.5 in the span of a week or two, and I've heard it said that a volatile market is an investor's ultimate lie detector test. Because we talk at the beginning, okay, what kind of risk should we take? What kind of risk do we need to take in the portfolio?
Right.
But then couple that with what kind of risk do you want to take in the portfolio? What kind of risk are you comfortable taking? And when we think risk, I guess it's worth defining. We're really talking about the mix of stocks versus bonds in a portfolio.
Yeah.
And we think of stocks being a diversified basket of stocks, and we might get into that a little bit more too.
Sure.
But we're thinking about a diversified basket of stocks and a diversified basket of bonds. The higher our weighting of stocks goes, the more risk we're exposed to in the portfolio. Just wanted to define that really quickly.
Yeah.
But so we set those parameters on the front end, often during good market times or average market times. And then we experience some price volatility and some swings, and the portfolio starts to move just like we knew that it could.
Yeah. You find out who's who a little bit. You know what I mean? Yeah. I think I think it's normal to of course you feel nervous. I mean, I don't think that really tends to go away. Maybe you learn how to adapt to it, or, and we'll kind of go through ways to plan for that ahead of time so that the volatility is assumed and expected, right? It's not some surprise that we were all caught off guard by. So if you plan for it, I think it's okay. I don't think it doesn't mean you can't feel nervous or uneasy. It's not fun. It's not fun to log in and watch it go down. I mean, you don't even have to look that far back. If you look back to, last April when it was all about tariffs, right? I mean, if you had invested at the start of 2025, let's just say the S&P, it was near 7,000. I don't know quite where it was, 6,900 and change. Then come April 7th, when Trump comes out and announces all the tariffs, you were down 16, 17% from that high point. It was down, quite a bit. And so, yeah, I mean, it's extremely unsettling, but now we have the benefit of looking, at hindsight and saying, okay, yeah, but 8 months later, I find myself 12 months later, even in the middle of another volatility-inducing geopolitical event, up from that low point and up from where I originally invested from. So I think that's an important framework is, hey, it's predictably unpredictable. We know it's going to happen. We don't know exactly when or how, but it's going to happen. And that short-term price swing does not take away from long-term growth, assuming you respond to it in the right ways. So,
I think that's a really important point, Brian, is how do we respond to this when it pops up?
Right.
We've already acknowledged it's absolutely human to be nervous when we see the market moving, and I don't think that's unreasonable.
Mhm.
Further, the question then becomes, okay, do we do something about it? Right? Do we sell when the market's down? Do we buy more when the market's down? So I'd like to take a moment and define a couple of things. One is, what are we buying? And the second is, for how long do we expect to hold it? So what are we buying? We're not here to give specific investment advice on a podcast. Working with a professional is really, in my opinion, the best way to figure out the type of portfolio and risk that you need in your specific situation for your goals to really give you the best shot to accomplish those goals long term, right? So we're not here to do that, but we can't say in general that we think the best way to own stocks and the best way to approach the stock market is in a highly diversified manner. And so we're big believers at Warburton Capital in buying the global marketplace, something like 14,000 stocks in 42 different countries, being as diversified as we can. That's the what. What are we buying when we buy stocks, either before, during, or after a volatile time? Why that's important. You will often hear on the internet, on our podcast, elsewhere, that in the middle of a down market, one of the best things you can do is to stay in your seat and not sell. And that's pretty decent advice if we look at history over time. The market has moved up and to the right over a long period of time with lots of volatility in the meantime for sometimes multiple years in a row.
Sure.
So it's not an easy ride, but that's a diversified portfolio that's done that. Many companies have come and gone along the way. And if you look at the top holdings of a decade ago or 2 decades ago, odds are they're not the same largest companies or top holdings of the market today.
Yeah.
So if we were to have only bought a handful of those stocks and picked individual securities, maybe the best thing would have been to continue holding them, or maybe not. There's really no way to know exactly. So one of the best things you can do in a volatile time is make sure that you're diversified enough and that you're now the win. Oh, well, I'll let you talk about the win. I've been talking for a long time here.
Yeah, I mean, well, so when I think again, because if you go back to what you hear online and what you see on social media, it's when is framed as, how do I know when the bottom is, right? How do I time this thing just right? And it's like, you don't, I don't think. Most people don't. You'll see people post that had a huge win and they timed it just right. And those stories make it seem so relatable and easy. And you see a lot of them in your feed. There are orders of magnitude more stories where there are losers that try to do that. And I don't know that the people making the decisions on what's going to happen in the world seem to know what's going to happen day to day. The story keeps changing. So the idea that you, in the midst of working and running a life and having a family and being busy, are going to keep up with all that and outsmart the collective wisdom of all of this, these investors worldwide, seems like a tall order. So I think your best bet on when, especially if you're pre-retirement, right, is consistently. Just buy consistently. If you're a consistent buyer of a broad basket of stocks, you're probably going to find that over time, you have a lot better outcomes than someone who tries to time the market. When you try to time the market, I mean, you've got to be right twice, right? If you're already invested and then this war breaks out, you had to know ahead of time to sell before things started going down. So let's say you got that right. Where's the bottom? I don't know where the bottom is. I thought the bottom.
It'd be good to know.
It'd be great to know. I would love to know. And I think it's normal to think through. I think the reason volatility is so unsettling is that we're kind of built as people to solve for uncertainty. Uncertainty is really unsettling. Even if we know something's going to be a bad outcome, there's almost some peace that comes from just knowing that. You want the good outcomes, but uncertainty is so uncomfortable. And so I think, to your point of what do we do? How do we respond? You feel like, I got to do something because I can solve this. I can solve it.
Yeah.
And I think people need to remember, we've talked about this before, the deliberate inaction is still a choice. It's still deliberate. It's action. You don't have to, you're not doing anything because you don't know what to do. You're making a choice to say, hey, no, I knew this was going to happen. We talked about this ahead of time. This was always part of the game when I got invested in stocks. I've done myself a huge favor by being broadly diversified. That's going to limit some of the volatility I might have otherwise experienced. No, but I mean, we know that this was going to happen. So instead of trying to time it just right, I think most people who are investing, they're in that accumulation phase of life, are going to do much better to just form a consistent habit that is almost ignorant of what's going on in the market. They're just buying at a consistent pace and sampling the market over time. That tends to lead to much better outcomes.
I want to pick up on a point that you mentioned there, Brian, because I thought it was very relevant where, um, you know, not doing something is doing something.
Mhm.
And that's a point you'll probably hear if you've been listening to this podcast for a while. That's a point you'll hear us make quite a bit is that, for instance, yesterday, I was showing you a clip I saw on social media
Mhm.
of someone who was analyzing portfolios and giving their thoughts. And it was really interesting. They called a certain fund in the portfolio lazy because the fund was focused on buying something and holding it for a long period of time, right? And that is an interesting concept because a lot of times it feels almost un-American, right? To just think that we can't beat the market.
Yeah, exactly.
It's in our blood. Let's go beat the market. Let's go. And sure, there are things you can do to help your chances and maybe even, help your expected return over time.
Mhm.
But are we gonna go out there and beat the market? Frankly, I think that if you're talking to a financial professional and a lot of their value that they're pitching comes from their ability to beat the market or their elite team of professionals in Manhattan,
Yeah.
their ability to beat the market,
Yeah.
I think that might be cause for concern because
Mhm.
why would I or my legion of MBAs from Harvard or whoever, why would we have any more knowledge about what's going on in the market than the collective wisdom of everyone? Because we have to think what's actually going on in the market. And if I may, volatility equals price swings.
Mhm.
It's the price of these companies moving up and down.
Yep.
I think back to COVID. That was a really interesting time to be a financial advisor
Mhm.
and to watch the market just plummet based on news.
Yeah.
So as news comes out, these prices adjust. Now, do you really think that the value of Apple or Tesla or some of these other big companies that the company is worth 20% less because of COVID happening? Maybe,
Yeah.
the market is agreeing that that's the current price, but at the same time, we can go, okay, perhaps this is on sale today. Maybe we do have an opportunity to buy. The price is the price at the moment, but we can look at it and say, well, either logically, things are going to continue to go down forever and we're just done. It's game over and the world's over.
Yeah.
Or we can look to the future and say, eventually things are going to come back. And if they do, then really any entry point on any day in a diversified portfolio has a positive expected rate of return if history repeats itself. Past performance isn't a guarantee of future results,
Yeah.
right?
Yeah, all the disclosures.
Yeah.
No, you're right. There's actually a lot of I'm sure you've seen that data, where investing at a previous all-time high does not take long to end up with having a positive expected return. You can look at like 1, 3, and 5-year return data following previous all-time highs, and you tend to have positive expected returns that are about in line with market returns in general, long term. So this idea that you have to time the market, I think is just flat wrong, let alone that it's very difficult to do once, let alone as a repeated strategy over time. So I think that's an important thing to keep in mind.
So let's do what we promised and dive into the question behind the question.
Mhm.
Ultimately, I think there are several questions kind of circling here, but there's a big one. It goes back to that idea of I have to do something. I think the question is there anything that I should be doing to protect myself?
Mm.
Right?
Yeah.
We buy a security system for the home in case there's a burglar, right? We take martial arts classes and learn how to fight in case we ever need to use it. There's all these preventative measures that we eat healthy so that we don't, get as many diseases down the road. There are preventative measures that we take in many areas of life. I think that's ultimately the real question going on is there anything I should be doing to protect myself?
Yeah. I I mean, the first thing is to try not to panic, right? And I think panic is different from I feel anxious about it. Panic speaks more to me like anxiety and action, right? And that's the big thing is you mentioned earlier, the volatility is this price swinging, but you don't lose money just because the price goes down. You lose money if you sell.
That's a good point.
And so I think your response to the uncomfortability is a lot more important. So what should you be doing? The first thing is, if you're already in the situation, not panic. Talk to somebody who can help you think through it if you're not already working with someone. I think if you're on the forefront, you're forward looking, you're saying, okay, you're saying all this, I know this is gonna happen, but like how do I put this into practice in terms of myself saving and investing? I mean, don't over leverage yourself. Don't put money into the market that you're gonna need in the short term. There's been a lot of good years recently, filled with some bad years or some bad intra-year activity, but you look at the response time from the COVID dip or from the tariff announcement dip,
Even 2022?
yeah, really was I mean, it was a bad year, but really quickly we got back. It's been a while since there's been a 5, 6, 7-year slog of downturn in equities or the lost decade at the early 2000s. I mean, there are these periods where markets are down for a long while if you just happen to get the timing wrong. So I think you need to have a long-term mindset when you put money in equities. It doesn't mean that the market won't be up in 12 months. It very well may be. It probably will be, actually, based on history. The odds are in your favor. But you should go into it thinking, I don't need this money by all measures I can estimate for at least 7, 10, maybe more years. This is long-term money. I don't have to care about what's going on with it because I'm not going to touch it. So I think that's the big thing you can do on the front end that helps. Again, it's still not fun to watch. I log in, I look at my statements. It's not fun when it goes down, but I'm not going to touch it. So it doesn't matter. I'm not losing any money. In fact, I'm in the phase where I'm buying. So I kind of see it as an opportunity that I probably, based on history and statistics, will be happy I took part in a year, 2 years, 10 years. But have the long-term mindset up front. You'd rather be pleasantly surprised than find yourself thinking this thing only goes up
Mhm.
and you happen to invest in January of 2000. So
That's a really good point. So is there anything I should be doing to protect myself? Number 1, don't panic. Work with a professional if you're not already. And if you are, utilize their service. This is why you have an advisor. We love hearing from our clients at Warburton Capital
Mhm.
in the middle of stock downturns. If you have cash on the sidelines, maybe it's a decent time to buy it depending on your time horizon, but make sure that you can put your money in the market and let it sit there for 7 to 10 years,
Yep.
just in case there is a long slog of a
Yeah.
downturn.
But I mean, you can tax loss harvest. Maybe you can do some of that and we can help you do that. I mean, but so there are things you can do to take advantage of the volatility without selling or without timing the market or right. There are other ways to add value. So I think don't try to time it, don't panic, all these things we mentioned. But what about, I guess real quickly, think about, okay, this is fine if we're 35, 40 and we're going to work for another 20 years. If I'm retired, I think volatility feels a lot more unsettling when yeah, it's like at retirement, it's like this hourglass gets turned over and the sand is falling and
Mhm.
your assets are slowly falling and you planned for it. It's okay. But, when you're working, you could just open the top and put more sand in. You have an income. It's like you can course correct. So I think it feels a lot more unsettling. I think that's where going into retirement with a really solid plan and a portfolio that's built to, again, anticipate this volatility and plan for it is really helpful. And that comes back to, when we plan for this, having enough money in not completely unvolatile, but less volatile assets like bonds or bond funds, or even money market funds for really short term spending. But having that shorter term spending need in less volatile, less risky assets, again, doesn't mean you're not going to feel anxious, but I think it can help because okay, I've got this many years of spending. Historically, the markets have come back by then. I'm going to be okay.
I like that comment. It reminds me of one of my earliest years as an advisor. I was working with a client, and I think I was 23 years old, something like that. So pretty green, knew the stuff, was advising clients, but hadn't had a lot of experience helping clients navigate downturns. And sure enough, you do this business long enough, you're going to find a down era, and clients look to you for help. And I remember the client telling me, I was giving him kind of a similar talk like we're talking right now about why you stay invested in the long term and da da da.
Mhm.
And he said, "Hey, Jonathan, that's great, but you're in your 20s. I can't earn all this money again. I don't want to earn it again." And that fear and panic was kind of setting in. Totally fair. It's a scary thing to be retired and watch your balance go down, not because of anything that you did, but in his case, it was helpful because we had money set aside in less risky things. That's why that he could live off of. And that's why working with a professional, I think, is so important. If a financial advisor can help you not sell during a downturn, that has a literal generational impact on you, your wealth, and your ability to retire or not retire. I've told clients before that have paid us fees over the years, and we were able to not sell when they were in a time of crisis and panic, and we didn't sell and came back. So with all due respect, I just paid for myself for 15 years, and that's just the reality of it.
No, it's true. I mean, missing the rebound is often more impactful than experiencing the downturn. So, no, I think you're exactly right. I mean, there's so much value add in the planning and in the advisor-client relationship that's beyond, "What do I buy? How do I time it just right?" That's the old school way that, kinda comes to mind or that you see in movies, but there's so many other ways that value gets added, to the portfolio, and if it can help on the behavioral side and say, "Hey, we've been here. We've seen this. We've planned for this." I think that helps people a lot who don't do this for a living, and they're willing to be a part of it. They know they need to. They know to make a return on their money, but it isn't their life, and so if you can share that experience and help affect what behavioral decisions are made on their side with their money, I agree with you. I think that's huge. I guess to wrap it up, what would be a good next step for people, right? If you're kind of in that accumulation phase or nearing retirement or even in retirement, maybe you want a second look, and you're nervous about the volatility, I think a good next step would probably be to reach out to someone, and we'd love to be those people. We'd love to help you think through it. That's what we do all day. But I think a good next step would be to have someone else that's objective and doesn't have the emotional tie-in you have to your money, take a look at what you've got and figure out if there is anything you actually need to do. Often there isn't.
I would do that.
Mm,
I would check in with someone. We're always happy to help do that, be the second set of eyes, or be the first phone call that you make in the middle of a downturn. That's literally why we do what we do. These are the times where we earn our money the best,
mhm.
I think. And then the second thing I would do after you've done that and you're confident that you've got a good plan in place that's going to take care of you, just turn off the TV. Close the news apps.
Yeah.
Don't check the market every day. Don't check your portfolio every day. There's really nothing to be gained by doing that except for more stress.
Yep.
Okay. Thank you for tuning in to this episode. We appreciate it. We'll see you on another one.